When people think of factors that drive gold and silver prices, they often look to major economic events, political crises, or moves by central banks. But what about tariffs? Can tariffs have a meaningful impact on precious metals? To answer that, we are taking a look back at some key moments in history when tariffs hit the headlines and left ripple effects across the global economy. From the Great Depression to the 1970s Nixon shock, we'll uncover what role tariffs have played in influencing gold and silver prices, and explore what this might mean with potentially new tariffs coming in the near future. If you're interested in seeing the bigger picture and understanding what really moves the markets for gold and silver, take a moment to subscribe to our channel. To start, let's go back to one of the most infamous tariffs in US history, the Smoot-Hawley Tariff Act of 1930. Enacted in response to the economic struggles of the Great Depression, this legislation raised tariffs on over 20,000 imported goods. It was intended to protect American businesses from foreign competition, but the global reaction was swift. Countries around the world responded with their own tariffs on American goods, sparking a trade war that deepened the economic downturn. So how did this tariff impact gold and silver? Well, interestingly, in the 1930s, the US was on the gold standard, meaning the dollar was directly tied to gold, and as a result, gold prices remained fixed. However, the tariffs and resulting contraction in global trade worsened the economic crisis, leading to a series of financial and political decisions that indirectly affected gold. By 1933, President Roosevelt abandoned the gold standard domestically, which allowed gold prices to find their true market value. Demand for gold surged as people looked for a safe haven asset, spurred by the government's own devaluation of the dollar and the instability of the global economy. Silver, while affected less directly, also saw increased interest as a valuable commodity, especially in regions where it was still used in currency. The lesson from Smoot-Hawley is that tariffs alone didn't drive the precious metals market. It was the broader economic decline, compounded by protectionist policies, that led to lasting impacts on gold and silver demand. Fast forward to August 15, 1971. President Nixon announced a sweeping set of economic measures, famously known as the Nixon shock. Facing a trade deficit and inflationary pressures, Nixon imposed a 10% surcharge on imports and, more significantly, suspended the dollar's convertibility into gold, effectively ending the gold standard and ushering in an era of floating exchange rates. The effect on gold and silver was profound. Once unpegged from the dollar, gold quickly began to rise as a free market asset, responding to inflation, economic uncertainty, and investor demand. The 10% import surcharge added to the volatility, further unsettling markets that were already anxious about inflation and the weakening dollar. Gold prices went from about $40 in 1971 to roughly $58 per ounce in 1972, a nearly 50% increase in 1 year. Silver followed a similar trajectory, with prices rising as inflationary pressures increased and investors saw alternatives to the dollar. But again, the tariffs themselves weren't the primary factor driving metals prices. Instead, it was the combination of removing gold's fixed price and inflationary fears that led to gold and silver's meteoric rise in the years that followed. And the most recent example from President Trump's first tenure in the Oval Office saw the Section 301 tariffs imposed on China in March of 2018. And while some suspected the Biden administration that followed might repeal the Section 301 tariffs, they decided to keep them in place, and they remain in action today. After the tariffs were implemented, some might assume we would see rising inflation and for gold and silver to respond in kind. Yet instead, we saw gold and silver prices decline. The reason is simple. While this was happening, the Federal Reserve was raising rates, which had a more immediate and more direct impact on the spot prices of gold and silver. These historical examples show that tariffs rarely act as a direct catalyst for precious metals price changes. Instead, they often contribute to a cascade of economic and political decisions that collectively impact markets. Tariffs can lead to trade wars, disrupt supply chains, and increase production costs, fueling inflationary fears or economic downturns that make safe haven assets like gold and silver much more attractive. In other words, tariffs are typically a piece of a larger puzzle. When they trigger broader economic instability or significant policy changes like abandoning the gold standard, they can set the stage for metals prices to rise. But on their own, tariffs generally don't produce immediate or sharp movements in gold and silver. With President Trump set to be inaugurated as the 47th President of the United States, he has already suggested he may implement universal tariffs on all imports as part of his economic strategy. Such a sweeping measure would be unprecedented and would likely spark trade conflicts with multiple countries, affecting global trade and potentially creating ripple effects across the economy. If these universal tariffs are enacted, we could expect a complex set of economic responses. For one, such a policy would likely raise the cost of goods and heighten inflationary pressures in the US, making imports more expensive for consumers and businesses alike. This could prompt the Federal Reserve to adjust its monetary policy, either by hiking rates to combat inflation or by introducing measures to stabilize the economy if recession fears grow. For gold and silver investors, this could mean that demand for precious metals might increase, not directly because of the tariffs, but due to inflationary pressures and potential instability in financial markets. If trade relations worsen globally and the dollar's strength weakens, gold and silver could become even more appealing as hedges against currency risk. When it comes to tariffs, remember to look beyond the initial headline. Tariffs often create delayed reactions as markets take time to digest their broader economic impact and for the ripple effects to play out. Just as we saw in the 1930s and 1970s, tariffs may start a series of economic shifts, but it's these secondary and tertiary effects like inflation, central bank actions, and geopolitical tensions that ultimately impact gold and silver prices. If universal tariffs were to come into effect, history suggests we might see a rise in demand for precious metals based on their expected outcomes. But as always, a patient and well-informed approach will serve investors best. Markets may not react immediately, but by understanding the cascading impacts, you can better prepare for shifts in gold and silver demand. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.